This is FRM Part 2, Book 5, Risk Management and Investment Management, and the chapter on Value at Risk and Risk Budgeting in Investment Management. This is another chapter written by Professor Jurian, and it's extremely well written. It's part of his textbook on value at risk. Let me just remind you that we've spent a good bit of time in a previous recording, a recent recording, in which we talked about marginal value at risk and incremental value at risk and value at risk in general. So what we're going to do now is try to link that discussion from before, maybe add a couple of things as well, and then try to make some optimal decisions. We began that process in the previous recording, and now we're going to extend it here. You'll see what I mean when you look at these learning objectives. So we'll define risk budgeting, and then we're going to go through lots and lots of elements that relate to value at risk and the investment process. So look at those learning objectives: investment management industry, investment process, risk management challenges. Then we're going to talk about some specific types of risk. And then we'll end with a really, really cool example. Let's go ahead and start kind of with the definition there. What was that first learning objective defined? So risk budgeting, comprehensive top-down approach that involves measuring, decomposing, allocating, and managing portfolio risk. Now, what have I been telling you for a really long time? Identify risk, quantify risk, and manage risk. So what we're doing here in this chapter is partly measuring, but a lot of it is managing. So in this terminology that Jurian uses, the decomposing, the allocating, and the managing, that's pretty much all of what I, in general, call managing risk. Now, when you think of total portfolio risk, what I always think of is standard deviation. I always begin with standard deviation. Standard deviation measures total risk, which means that it's total. There's nothing else out there, right? It's total. But then we can chop it up into its component parts, right? So the decomposition and allocation across managers and different securities and even asset classes. And so what did we talk about just in that previous recording? Our goal is to combine the interests of investors who want lots of returns but little risk. So we're going to, try to maximize returns while minimizing risk. It's difficult to do that in calculus, do a maximizing and a minimizing at the same time. So we'll probably have to pick one of those two. So what did I just say? Yeah, we start with standard deviation, and then we try to use it to evaluate our risk position inside of this risk budgeting. So look at that third triangle point. Risk budgeting requires a measure of portfolio risk, such as, of course, this chapter is called value at risk. And so it naturally fits in. Of course, value at risk, we're looking at that left-hand tail, downside risk. And if we assume that returns are normally distributed, then this is a measure that can be forward-looking. And so it's important to remember that standard deviation is extremely important. We love standard deviation, but it doesn't tell us the complete story. Even though it measures total risk, the complete story reveals itself when we use standard deviation in some parts, like value at risk, and then when we chop it into its components. And that's what we're going to do here. So steps of risk budgeting, these are pretty standard stuff. Set risk budgets, establish asset allocations, compare the risk budgets. Notice that we put that word continually in there. That's taken right out from the chapter. That's important. Continually, what does that mean? Does it mean annually? Probably not. Does it mean hourly? Probably not. So somewhere in the middle there. Sometimes these risk budgeting models are weekly, sometimes they're monthly, but you need to be aware of the time frame. And then, of course, the monitoring requires us to adjust the asset allocations because, look, what do we know every day on the floor of the New York Stock Exchange, on the floor of the bonds exchange, on the floor of the derivative markets? We know that prices, they go up and they go down. So we've got these weights that are naturally changing. So we're going to have to adjust our asset allocations so that we swing back to our target risk levels. What do we like about this? Top-down approach. And so think about top-down, you start way up here at the top, like the entire macro economy, and then you kind of flow down. We recently had a giant snowfall here in Pennsylvania, so we'll do the snowflakes all the way down to, the bottom point, which might be something like selecting a particular security. So it's hands-on and it's extensive. You'll see that as we go through this. And that's one of the interesting things about any kind of a top-down approach, because you start with the big, the gigantic, and then you work your way down to kind of a point. And so, in order to go from way up here all the way down to that point, then you got to do lots of work. So, extensive method for managing risk. And also, if you're able to quantify some of these, that of course it's dynamic. Now, you don't have to quantify it, but it makes it a little bit more clear that you can look at individual components of the risk, change those things, and then see what the dynamic results are. How about looking at some factors that impact risk management? And what the chapter does for you in this section is take a look at the difference between the sell side and the buy side of the investment industry. Think of the buy side, I always just think of a pension fund when I do that. The sell side, just think of investment bankers. And so there's a table here. This is reproduced right out of the chapter. And this takes a look at the different impacts, the different elements, the different qualities of sell side versus buy side. And so note that in the middle column versus the far right column, those are kind of like opposites, right? So I would memorize, the features down the left-hand column and then the opposites there for investment banks and for pension funds or investors in general, right? Horizon, short versus long term. I mean, that should make perfect sense. Turnover quick, turnover slow for pension funds, right? Lots of leverage for investment banks, probably not so much for investors. And then risk measures, of course, financial institutions have led the way in, kind of bringing up value at risk to its current level, and then layer that with stress tests. Not so much so in the use over on the buy side. Risk controls for pension funds and investors in general, right? Diversification, we know that, benchmarking, and then the investment guidelines that come from the policy statement, which is very different from position limits and value at risk limits. Now, of course, banks, they focused on selling their instruments rapidly. There's no reason for an investment banker to provide capital to a corporation or a government and hold on to those securities for hundreds of years, because those securities could fall in value. I mean, they could choose to do that. I mean, remember about, maybe 25 years ago, David Bowie issued a bond, and the investment banker didn't sell those bonds to the public. The investment banker kept them because they were of such high grade. And I'm pretty sure those David Bowie bonds are still not available. Now, of course, you guys who are rock and rollers like I am will know that there are lots of rock and roll superstars out there who have recently sold their catalogs to raise capital. Banks highly leveraged, of course, this means high leverage risk. And so the traditional risk management measures, which begin with standard deviation and then flow naturally to value at risk and those stress tests. Remember, we spent, how many chapters did we talk about stress testing, where we take a look at this big old Excel spreadsheet and we say, what happens if this thing right here, this cell, C19, what if C19 changes dramatically? What happens to all of those outputs, which would include value at risk? Investors, like pension funds, on the other hand, hold these securities for long time periods, low leverage. Value at risk is not really commonly used. Typically what happens is that these pension fund managers and investors will have some kind of an optimal allocation model, whether it's Excel and Solver or some kind of proprietary algorithm. But we're trying to minimize that total risk, minimize standard deviation. And then, of course, we layer that with factor analysis. We try to expose the clients to, maybe interest rates or a certain currency or, whatever the Fed is doing. And then the way we evaluate that, both during that optimal allocation and considering the factor inputs, is to look at tracking error. The investment process, we've talked about this many, many times over multiple slide decks. Step 1, determine strategic and long-term asset allocation to various asset classes. And so, what we're trying to do is say something like, all right, here we have the bond market and here we have the stock market. What is our strategic? What is our long-term allocation? Maybe it's 30% fixed income and then 70% equity. So we determine what that is, and that's what those allocations are there in the illustration on the right, 55%, 10% and 15%, et cetera. And so that looks like there's lots of securities in there, including venture capital, offshore, and fixed deposits. All right, so what's the aim here? Balancing the expected returns and risks based on that particular risk budget, right? Remember we talked about those buckets or those risk capsules. And so that's what we have, and we want to make sure that we allocate those in which we're minimizing standard deviation or some other kind of a risk measure while trying to get the most return for each given level of risk. And so note the second circle point establishes the amount to invest in those different asset classes. And then, of course, we need to compare it to a benchmark. So that's the strategic asset allocation. And then what we need to do is say, all right, what is out there in the universe of managers that can provide us with our consistency to risk and return objectives? So look at step 2, recruiting active fund managers and then passive fund managers, and then regularly monitor those and evaluate their performance using some predetermined guidelines that will probably be outlined in the policy statement. And there's that tracking error that pops up again. And so it makes sense then to be able to evaluate the performance of a fund manager relative to something, whether it's a group of his or her peers or some appropriate benchmark. All right, how about hedge funds? There's an entire section in the chapter on hedge funds that kind of had me scratching my head there. This is kind of like a determination of, are hedge funds, are they on the buy side, or are they on the sell side? And so the conclusion was that they're probably way more similar to the sell side because of their leverage and their turnover. And I always tell my students this. I say, look, you guys, when you grow up and you become, some kind of a financial professional, you need to think about becoming a mutual fund manager. And this appeals to them, kind of on several different levels. And I say, look, if you're a mutual fund manager, you get to tell people, you say, hey, look, send me your money, and I'll invest it in these bonds and these stocks. And, maybe I'll have some subcategories in there. And I tell students, this is a great life, but you're limited to that. Why don't you grow up and become a hedge fund manager? Because what you can say is that, hey, send me your money, and I don't really have to tell you what I'm doing with it. I mean, within some rules and regulations, you can't have your money anytime soon. And by the way, you need to send me at least $1 million or maybe $10 million, and I'll get back to you when I'm done after some time period. And by the way, I'm going to pay myself a lot of money. So there are lots and lots of great things about hedge funds, but there are some drawbacks. But the important part here, as it relates to the learning objective, is that Jorion seems to suggest that hedge funds are way more similar to the sell side. And here are some good reasons here. Leverage, liquidity risk, which means that when that hedge fund manager can essentially invest in almost anything, like a 17th century desk from one of the English kings. What's the secondary market for that thing? There might be 4 people in the whole world who might be interested in that. So there are liquidity issues. They're not listed on an exchange. What did I say earlier? There you go. High net worth individuals, low transparency. Most hedge funds do not disclose information. yeah, potential competitors, right? If I'm investing in this furniture, then maybe my competition will do that. So look at the last arrow point. Difficult for clients to access the actual value of their investment. And so the hedge fund manager is really, really saying, you know what, you need to trust me. That's pretty much the story. Keeping in line with the same kind of thought process, illiquid assets that trade less frequency. So those risk measures probably don't reflect recent transaction prices because there's not a secondary market. And so there are biases in here, low systematic risk, low correlation, low overall risk as a result of lower volatility. So what did I say just a few moments ago? Lots of great things about investing in hedge funds, but there are some drawbacks. And so the people who invest in hedge funds ought to be aware of all of the benefits and the risks. And I think that was pretty much the story behind this part of the chapter. Moving on to types of risk. So let's start with absolute risk, then we'll move on to relative risk. So look at that equation there in the gray box. So the rate of return on any kind of a financial asset is really just the sum of the individual weights in that asset times the asset's return. Now, of course, if we're doing this in the expectations operations, then the return on that asset is probably going to be positive, right? We'd never invest in an asset that was going to have a negative expected return. But total possible losses over some time period can be negative. Right, so those individual asset returns, they can be negative. So this is a total possible losses. And then, of course, we're going to compare that to a benchmark. So there's our relative risk measure, and we're going to call that the tracking error, the return on our individual asset or our portfolio of assets minus some kind of a benchmark. Call that tracking error. Note that tracking error, it's the beginning of what I talked about back in the very first slide. It's the beginning of computing some kind of a standard deviation. How about policy mix risk? This goes back to, in fact, Jorian mentions the Brinson, Hood, and Biebauer study, which is an attribution analysis. And really the idea is let's attribute the performance of a fund manager to either security selection or asset allocation. And one of the fascinating results of this is that the biggest return to a portfolio comes from asset allocation rather the selection of individual securities or individual portfolios or individual fund managers. So look at that first circle point under policy mix risk. The risk of loss as a result of allocating the wrong weights to different assets in a portfolio. Let me give you just a quick math example here. Suppose that we're picking between one bond and one stock, and the return on the bond is 10%, the return on the stock is 20%. So if we have an equal weighted portfolio, we're going to get 15%, right? 10 and 20, that's 15. But let's suppose that I think I'm a super smart fund manager and I say, no, bonds, they're going to outperform. So let's invest 90% of our wealth in the bonds and only 10% of our wealth in the share stock. So I'm wrong because let's suppose they produce the 10 and the 20% expected return. So my return is way, way less. So that's an allocation error. So notice the second circle point there. The largest source of risk relative to active management, a value at risk and asset value at risk comes from this policy mix. So make sure you're aware that security selection is extremely important. But according to these three authors, that asset allocation can dominate. How about active management risk? Now we're getting somewhere where we're going to try to bring in the specter of the problems with those total losses, right? The standard deviations. So active management risk, the sum of profits or losses from all active managers in relation to the benchmark. And so look at the equation inside of that top gray box. So that return on the asset is the return on the policy mix plus the return on active management. And we can compute those using the weights according to the portfolio and the weights according to the benchmark. And we can take the differences and we can sum all those, and we can get that active management risk. Now, what the chapter does for you is use an example of a Canadian pension fund that reports that active management value at risk is relatively small, while the policy mix value at risk is relatively high. And the chapter asks the question, why is this so? This is just an illustration of exactly what happened in the article published by those three professors. Active management risk, boy, notice what we have in the bold, is minimal for well-managed funds. All right, so what does that mean? Well-managed funds are defined in this case as those that are well-diversified and are, I don't want to say dominated, but clearly influenced by indexing or some type of an index strategy. All right, how about funding risk? I think this is really fascinating here. Possibility of loss when the value of assets is insufficient to cover the liabilities of the fund. So here we go back to capital structure. Here we go back to the balance sheet. So you have the assets over here, and you have the liabilities over here, the source, right? And then here's the investment over here. And so a surplus is going to be defined, of course, it's going to be defined as the difference between asset values and liability values, but we're always interested in change in surpluses. So let's go ahead and put a delta in front of the S for the surplus, delta in front of the A for the assets, and delta in front of the L for the liabilities. And one of the things we can do, we talked about scaling alpha before. We can scale this, your chapter calls it normalizing. So let's just go ahead and divide by the assets. And so we can get that return on the surplus is equal to, forget about all those deltas there. Look on the far right side, it's going to be return on assets minus the return on liabilities, weighted by some measure of leverage, liabilities over assets. And so the surplus at risk, the SAR, occurs, of course it occurs when the surplus is negative. When surpluses are negative, and then the change in the surplus is even more negative, then we need to be concerned. And so the fund sponsor is then going to have to make additional contributions to turn that surplus from being negative into positive. Let's take a look at a quick example here. Let's suppose that we have a fund that's got 500 in assets, 450 in liabilities. So what is that surplus? That's 50, right? So the expected return on the surplus is 5%. Volatility is 12%. Let's go ahead and compute the value at risk and the deficit, and let's do this at a 99% confidence level. All right, so the expected surplus growth is what, 5%? Where do we get that? We've got that 5% return, right? So take that times the 500,000, so that gives us 25 million. So our expected surplus in 1 year's time is the original 50 million, right? The 500 minus the 450 plus that surplus growth, so that gets us up to 75. Let's go ahead and compute using that well-known formula for value at risk. There's our Z-score. What do we do? 99%, so that's a 2.33. Remember, that's a one-tailed test. Times our 12% volatility, times our original asset value, so that's 139, right? So let's go ahead and let's take the 75 minus the 139, and that gives us, what is that, about 65 million. So there's a 1% chance that the surplus will turn into a deficit of around 65 million or more over the next year. So think about what we're doing here in all of that first slide where we were identifying and decomposing and managing. So we're doing this here. We're saying, look, we have, this 99% confidence, 65 million. So we need to prepare. We need to prepare to be able to make some contributions at that 99% level of confidence. All right, how about a more intricate example here, surplus at risk? So here we've got a couple of different items here. So assets in this example are 600, liabilities are 480. Return on assets is 6, while the return on liabilities is just 3. Volatility of assets is 8. Volatility of liabilities is just 2. And let's go ahead and consider correlation between assets and liabilities. Let's suppose that's running right at a 0.5. Let's go ahead and compute the 99% surplus at risk of the fund. All right, so let's compute the expected surplus growth. So notice I put the assets in green, so 600 times the 6 minus the 480 times the 3. So that gets us 21.6. So our expected surplus, and this is the same math we just did. So we have the 120 plus the 21, that gets us up to around 140. Now, in order to compute the variance of the surplus, we need to go back to, when do we go back to? At least graduate school statistics or econometrics, and maybe even undergraduate days. So the variance of two variables, x and y, if we want to calculate the variance of the difference, then, so we need to do the variance of one plus the variance of other. And notice what we did. We put a minus sign in there because we're kind of used to having plus signs in our covariance formula, but we need to subtract this out to reflect the benefits of diversification, right? So that's 2 times the covariance. And we'll go ahead and substitute the individual standard deviations and the correlation coefficient. And you can pause the video if you want to go ahead and do the math and take the square root. And then go ahead and use our normalized value at risk at the bottom there. So what's our volatility? Around 44. And so the surplus at risk is that, well, what do? We'd add the 21 up there at the top. We'll add the 44 to it, multiply that by our 1% critical value, and we get, what is that, about $81 of surplus at risk, 99% level of confidence. How about that learning objective that relates to sponsor risk? Remember, the plan sponsor is almost always the employer. It doesn't have to be, though. I mean, it could be a union, or it could be me, right? I could be hired as the plan sponsor, but mostly it's the employer. Ultimately bears the responsibility for the pension fund. And so there are 2 kinds of risks here. There's cash flow risk, right? I've got all these people who have retired and who are expecting me to pay them. And then I have all these people who are retiring who are going to expect me to pay them. And so I'm saying, all right, here, this is the promises that we made to you. Let me throw all this money at you. And then I need to turn around and say, okay, where's all this money coming from? All right, so that's cash flow risk. And then, of course, economic risk is, when I turn around and I look at the source of my investments, maybe I have some good bonds out there, and so the bonds pay me a coupon, and then I pay the employees out there. But then I look beyond the bond market, and I look at the entire macro economy behind me, and I say, oh boy, what's going on? Do we have crises? Do we have 2008 bubbles? Do we have 2020 COVID? Do we have 1987 stock market crash? Do we have 1933 depression? Do I need to go all the way back to, here, let's see how smart you guys are, 1741 tulip bulb mania? You guys know anything about that? So the economic risk, of course, plays a big part in this sponsor risk. All right, how about that big learning objective on the uses of value at risk in investment management? All right, so how can we use value at risk, and what is it going to do for us? So we can check for compliance, right? Catch rogue traders, managers who delegate investment decisions to other people. We need to make sure that those traders are not operating over there in the closet with a locked door, with chains on them so that they can't get out and we can't get in. We want to know what he or she is doing inside of that. So we get all the locks off, we open the door, and we say, hey, let's make sure that we know what's going on. So this identifies unauthorized trading and out of positions. And of course, this will show up in our value at risk computations. It's also going to help us monitor risk. Has the manager exceeded his or her risk budget? It helps in assessing similar bets by different managers, right? We can look at each of these managers as a silo, and we can compare value at risk. And we can compare, not only just value at risk like we've just done, or surplus at risk like we've just done, but we can go back to the last chapter and we can look at things like marginal value at risk and incremental value at risk. We can do all that stuff to make a, right here, right, we're in the umbrella, so that we can look at it from the umbrella standpoint, looking down, and here come the snowflakes falling, and see, does the snow melt when it hits one of our managers, or does it ice up when it hits one of our managers? So whatever it is, we need to compare. And then finally, it helps in evaluating the volatility of the overall market, right? We're not going to evaluate each one of these silos individually, although that's what we said we're going to do. That's not going to be the end point. We're going to put them on top of each other or stack them next to each other and say, okay, what does this mean for our entire risk budget and risk portfolio? What we can do also is reverse engineer the sources of risk. So we can look at the components of value at risk to be able to identify those individual positions that are going to have the largest impact. So that's going to help us identify those silos where we can say, oh my gosh, if one factor, let's say interest rates or inflation or GDP changes, it's going to affect these silos over here by 1% or 2%, but over here, this silo 20%. All right, so we can evaluate those individual positions. And then going back to my umbrella, centralized risk management. That makes sense. Let me repeat this again. The most crucial step in the investment process is the strategic asset allocation decision, right? So we can start off by mean variance framework, but we can add our own proprietary inputs. Maybe there's some factors, maybe there's something else out there that give us our optimal risk return trade-off. What we can do then is we can use value at risk to allocate funds across these assets. And we can even add new assets or subtract new assets. Oh my gosh, look at the third teardrop point. There's that marginal value at risk that we did in the previous slide deck. These managers' guidelines that limit notionals and sensitivity. So think about this. We have a manager out there that says, all right, look, here's 10 million, that's all you have. And then here are some hedge ratios, or here are some betas, or some other kind of factor sensitivity. What that does is, that gives us a great amount of input and output data so that we can make an evaluation, but it doesn't give us the complete story. It's insufficient in the presence of leverage and new securities that are out there, right? Financial innovators and engineers are coming up with new securities every day. And so, we need to make sure that we're aware that if we fail to account for these risk variations and new correlations, and maybe, dare I even say, new copula relationships, right? And what we can do is then consider these silos and how they relate to everybody else. All right, how about a risk budgeting recap? Top-down process, determine total risk. So we start with standard deviation, then we move on to value at risk. Optimal allocation for each portfolio component. It ensures that the value at risk at any given time is probably going to be less than its target value. So diversification effects should be evident. All right, let's go ahead and take a quick example here. Pension fund wants to allocate $3 billion to 4 asset classes, total volatility 9%. Assume the funds are normally distributed. Let's take a deep breath and remember of all the problems with that kind of an assumption, but let's go ahead and make that assumption anyway. So our value at risk at the 99% confidence level is, what is that? About $630 million. Let's go ahead and look at that final learning objective, budgeting across active managers. What do we know? Active managers are evaluated using their tracking error. And we know that tracking error is simply the difference between the active return and a benchmark return. Remember, that benchmark could be, something as simple as the S&P 500 index, but it's probably going to be a little bit more complex. The best benchmarks are designed to mimic the performance of the active portfolio. Anyway, what we can do then is use that tracking error to determine the information ratio. Remember, that information ratio is going to tell us something about a manager's ability to outperform. And look in the gray boxes there. That equation on the left for the information ratio uses the notation from this particular chapter, where the numerator is the excess return and W is the tracking error volatility. Now what we did is we cut and pasted the equation for the information ratio from our previous chapter, just so you get a sense that we're not really changing anything around. What we're simply doing is, in this chapter, just changing notation. So nothing has changed about the information ratio. Now, the authors of this chapter seem to suggest, and this is probably a good idea, that an information ratio of 0.5 probably represents good performance or acceptable performance. And so what we want to do is we want to identify those managers who have high information ratios, but we can't just look at the information ratio by itself. We need to look at volatility. We need to look at tracking error volatility. What this is going to end up doing is we're going to be able to identify managers who have superior performance and then allocate them more capital. All right, so look at that purple arrow point. Goal of the active manager is to maximize total portfolio information ratio with respect to tracking error volatility. So what we're trying to do here is to determine what is the value added for a particular portfolio. So look at that equation right above the gray box. So the mu sub p is the added value for the portfolio. And notice there are two equal signs there. So we have two components. And that first one should be fairly obvious. If we sum the product of the proportions allocated to each manager times the manager's excess return, we get some value added, right? What do we want? We want to allocate lots of wealth to a manager who has lots of excess return. But let's go ahead on the other side of the equal sign and substitute that information ratio so that we can make a determination on that particular variable. So all we're going to do is take the product of the information ratio times that tracking error. Now, one minor point here before we move on. If we make the assumption that the excess returns between and among managers are independent, meaning there's a correlation coefficient of 0, then that portfolio tracking error volatility can be reduced to that expression there at the top. Now, those of you who happen to look at the chapter, and I always recommend reading the chapters, you'll note that in this section there's a series of objective functions and constraints, and then some derivatives, taking first derivative, and then some simple algebra. And so rearranging all that stuff, this is what we get. So look at the second arrow point. After maximizing the information ratio, given the constraints of volatility, we get this equation here. So we're going to take the weight times the individual tracking volatility is equal to something there over on the right. So we have information ratio of the manager, information ratio of the portfolio, and then some measure of tracking error. All right. So if we divide both sides by the W, by that tracking error, we get this. So right at the top, this is probably the most important equation for you to memorize out of this chapter. So the weights can be allocated. So what are we trying to do here with this learning objective? What are we trying to do here as good financial risk managers? we're saying something like, hey, we've got a choice between and among all these managers. Let's find somebody who has lots of an information ratio with little tracking error. All right, so that's what this X sub I, proportion of the portfolio managed by manager sub I. And notice what that formula looks like. We put the red IR sub I. That's the information ratio for manager I. So as that increases, right, then the proportion is going to increase as well. So we want lots of information ratio for manager I. And then look at the green on the bottom right there. That is the TEV of manager I. So we want a little bit of that. So we want, think about this, we want, lots of return with little risk, lots of information ratio with little tracking error. And of course, they're adjusted by the information ratio and the tracking error volatility of the portfolio. Let's go ahead and look at an example here to finish up this slide deck. Let's suppose we have a pension fund allocate $600 million to 2 active fund managers. Goal is to maximize the information ratio with a tracking error volatility of 3% as the constraint. And so what we're doing here is we're simply going to use that equation from the previous slide, which is the result of some really fascinating calculus. So look down the left-hand column. We've got manager A and B and the benchmark, and then the portfolio. So there is the TEVs for each one, and there is the information ratio. So that's given to us, 56 for manager A, 44 for manager B, and then, of course, 0 for the benchmark, and then the 0.8 for the portfolio. So the question then becomes, how can we fill in that column weight over on the right-hand side? So pretend that that column is empty. What we're going to do is use that equation there, X sub I, and this is pretty simple math, of course. So we'll just take 56 divided by the 8 and then weight it by the by the ratio of the tracking error volatilities. And we get 42% for manager A, and then we get 33% for manager B. And this makes sense, right? What we want to do, since they both have the same TEV, we want to allocate more to that manager who has the higher information ratio. And instead of just saying, oh, I'll just put 10% more into manager A and 10% less into manager B, we use this great calculus that provides us with this equation, and we come up with these optimal weights. So that 42% for manager A, 33% for manager B, these are optimal weights, right? We're trying to maximize information ratio, minimize tracking error volatility, and so those weights have to sum to 1, which means we have 25% in the benchmark. So those weights over on the right-hand side, 42 and 33 and 25. Now you back into 25 to get to the portfolio weights of 100%. I think this is a really cool example. Of course, if I were creating exams, this would be at the top of my list out of this chapter. And so if you look at these learning objectives, what are the most important ones there? I like that one in the middle, distinguish between and among the following types of risks. Those are great questions in there. And then everything that we talked about in this side of this chapter for value at risk, and then the final one there at the bottom. Notice they calculate the risk budgets. I'm guessing that you're excited when there's a learning objective that asks us to calculate.